Welcome to Pharmacy Accounting Basics. My name is Joey Mattingly. Today we're going to be talking about the principles of debt. The learning objectives for today's video are to define the components of debt and explain their relationship. We also want to be able to explain why more interest is paid on a 30-year loan when compared to a 15-year loan at the same interest rate. And then we want to apply these principles of debt to our student loans, if you have them, right? So let's just keep it simple and start with the components of debt. We have the principal, so you'll notice, again, I'll use the principal with an LE and principal with an AL. Be sure you're paying attention to know when which is which, right? So we're talking about finance, and the principal here is talking about the amount of money that's taken out on loans. You say if you need a $100,000 loan, let's say the principal amount of the loan. Then we have the term. So the term refers to the time or the length of time that you're going to finance the loan for. And then an interest rate. So what is the rate at which you're borrowing the money? This is the component that makes up the lender. They make money off of this interest rate. So there's some costs associated with loaning you the money, and they want to be able to make a profit and be a sustainable business. So they're not here to loan you money for free, right? Now, some of you may have gotten loans from your parents and didn't have to pay any interest. So the bank's not going to be your mom or dad, so they're going to want you to pay them. All right, so let's take a look at an example, and assuming that we want to take out a $100,000 loan. We agree to a 15-year term for the loan at a 5% interest rate. One thing that you also hear come up, and this comes up quite a bit when you're borrowing money for a house or a car, is you might see something related to the loan to value ratio. So this actually is more about when you think about like borrowing money for a house. The actual loan amount, the actual principal, will end up being $90,000. Say if you put down $10,000. So say if it needs to be a 90% loan to value or something. This is important when we see about different lending mechanisms, especially in mortgages. I think we see that the most. You'll see it with cars. You'll see a lot of zero down, right? So that means the loan to value is 100%. You're putting nothing down, right? So just thinking about that. That's just that LTV ratio. Primarily, I'm going to focus on talking about principal, term, and interest rate, okay? So when we think about these components, what actually happens when you double the term length? So nothing else changes. We just want to mess around with that term length and see how that impacts our payments and everything. So let's use that $100,000, 90% loan to value. So we put a $10,000 down payment, and we took out the loan for a 5% interest rate. And for a 15-year loan is our original example. Once we do the math, and I'll show you a little bit more detail about the math, that comes up to a payment of $711.71. And you'll actually pay this payment throughout the life of the loan. And the total interest that you will pay over the life of the loan, so all 15 years, total interest will equate to about $38,000. So now let's double the length. So the same numbers, 100,000, 90% loan to value, 5% interest rate, but now we've got a 30-year loan, okay? So what happens to our payment? Our payment drops. Our payment drops from $711 to $483.14. So wow, nice little drop there, a little over $200 drop. What happens to our interest? Our total interest more than doubles. It goes from $38,000 to about $84,000 in interest. What the heck happened? We just extended the life of the loan, but we still took a 5% interest loan. So how did we pay more? I think this component or this understanding of the relationship between the principal and the interest and the term, when you understand those three critical components, that will, I think, really change your life when you think about debt, when you think about taking on new debt, paying off your debt, just understanding those three components. Why does it happen? Well, it's around what's called an amortization schedule. So this is basically a table of periodic loan payments, and the loan payments are going to stay the same the entire time. It's kind of how loans are typically built out. And that the amount for the principal and the interest actually will change over time. So what happens? Let's look at our 15-year scenario. Okay, I'm showing you here month 1, month 2, and month 60. So at the I guess at the beginning of the 5th year, I'm trying to think if it's the end or the beginning of right at around 5 years of the loan. So showing you month 1 and month 2. The payments across the board, whether it's month 1, month 2, or month 60, will always be $711.71. However, the principal changes. The amount each month that you pay towards the principal and the amount you pay towards the interest change, and they change in an inverse way. So in the first month, you paid about exactly $336.71 to the principal. So your principal, you took out $90,000. Remember, we said it was a 90% loan to value, so your loan principal was only $90,000. Well, $336 come off of the principal after that month 1. So guess what? In the following month, when you pay your payment, you actually have a smaller balance, principal balance, and so your interest decreases. Now, does it decrease a lot? No, less than $2 here from month 1 to month 2. But look at month 60, right? By month 60, you're paying like $100 less in interest every month. And almost $100 more shifted over to the principal. So after 5 years on a 15-year loan, you can see that shift. And look at what the balance is. So if you wanted to just write a check to pay off the loan today, at month 60, you'd need to write a check for $67,101.38. Or you just keep paying your monthly payment, $711.71. That never changes. So let's double the term. Now what happens? So we look at month 1, month 2, and month 60 again. So let's take a look here. Our payments, wow, so we went from $711, like we said earlier, to $483.14, so $483.14. Same thing, month 1, 2, and 5 years later. Our principal payment, now check this out. So when we look at the principal and the interest, what happens here? So the amount we pay towards the principal goes down a lot. Like it's like a third, it's like 30% of what amount we were paying in the principal in the first scenario. So our principal goes down, so how much of our interest goes down? Well, surprisingly, or not, this is where you shouldn't be surprised, or once you understand the relationship between the principal, the interest, and the term, the interest is just a function of the principal, right? So you had $90,000, and that 5% interest rate's how you calculate that $375. So you pay less on the principal, and that's why your monthly payment is less. Okay? So this is why you've probably had your mom and dad or whoever talk when they talk to you about paying off debt. They'll say, "Oh, you should maybe pay a little extra on your loan to pay down the principal, or whatever." This is what they're talking about. They're saying, how do you get that principal to come down so that each month, when the lender calculates the interest that you owe for that month, they're calculating it off of a lower balance. So look at what happens with, again, month 1, 2, and 60. By month 60, so 5 years into it, we're still only paying about $138 a month towards the principal. And the principal has only gone, after 5 years of paying on this sucker, we've gone from $90,000 to $82,645. So this is where, before we get into questions about loans, this is just the math, okay? Like, we'll talk more about other components of debt, but the pure math and relationship between principal, interest, and the term have to be a fundamental core thing that you remember for the rest of your life. Just understand how they relate, understand what your extra payments go for. Before you take on a loan, read the fine print or ask questions like, what happens if I want to pay it off early? Do I get penalized? Can I make extra principal payments? What's the deal, right? So just because you're trying to figure this out so you can understand how to balance your monthly payment and what's coming out of your paycheck or your bank account, and then how long you're going to be paying on this debt. So I think what comes up a lot are all debts bad, right? Like sometimes if you've read financial planning books. Maybe you've and I won't mention their names, but there's a few well, I guess I mentioned Robert Kiyosaki. So yeah, I mean, there's Dave Ramsey, who's real big on getting rid of debt, and a lot of financial folks that are all, eliminate debt, eliminate debt, eliminate debt. And don't get me wrong, it's easy to kind of jump on that bandwagon of yeah, sure, debt's bad, but let's ask a few more critical questions. Can you afford to take on the debt? Right. So if you take on a debt that you can't afford, then that's probably going to be in the bad category. Now, did the debt help you acquire something you needed? Now, this is something I like to think about, and I think about all the time for myself when I start to feel bad about my student loans. I think, well, my parents didn't have the money to pay for my college. So if I wanted to go to pharmacy school and become a pharmacist, I needed to take on the debt to acquire something, my pharmacy degree, so that I could then get a job as a pharmacist. So, in a way, I don't think that my student debt was bad per se, right? Like it allowed me to do something that I wouldn't have been able to do otherwise. And then maybe asking some other questions like, are there tax implications with the debt? So this is something that's always frustrated me with student loans. For the longest time, student loan debt was one of those debts that, once you made over a certain amount, there were no tax benefits with, or tax write-offs or whatever with student debt. But that gets more into tax policy and other things like that. But just understanding what are the benefits of a debt. Are there other, and not just taxes, but are there other incentives to taking on the debt? You have to be careful. Depending on who's in Congress and the White House, like what political parties are in power, or what's the overall the push for policy. Sometimes policies change, and the policymakers write in incentives for you to take on more debt or to not have debt. You'll see some folks just think, well, just debt's bad, so just always try to get out of debt, be debt-free, debt-free, debt-free. If you can get to where you're debt-free and build up enough cash to where you never have to go to a bank again, that could be great for you. I mean, that could be a fantastic way to live. I just think it's probably difficult for a lot of people to get there. Not that it's impossible, but just thinking about good debts and bad debts, I don't know if I would define anything as good or bad. I just take out a lot of times I think good and bad, we put smiley faces with good and frowny faces with bad, or we have some emotion with it. Take the emotion out, do the math, see try to be rational about what the debt is. All right, so how do we apply these principles? And different type of principle here. So principle PLE, principles. How do these principles apply to student debt? Now, student debt is something that I am incredibly passionate about, and sorry for the self-promotion, but I've got to talk about one of the papers I wrote this past year regarding student debt cancellation. So one of the things that has come up is that several presidential candidates and congressional candidates have talked about canceling student debt. And I just thought it was important that, okay, if we're going to talk about student debt, why don't we do the math? Let's take the math of the graduating class of 2017. So I was able to use national data and estimate the potential debt. And what I came up with is that if you were to just lower the interest rate, and so on average, students that are graduating from the School of Pharmacy are going to have around 6% total interest. So some of their loans are going to be 7.9, 6.8, some might be under 5, but on average, you're going to be in that 6% ballpark range. And so I use that for easy math, just to kind of do some basic modeling. So based on the beginning principle, so there's about $2 billion in debt that go out to about 12,000 students that were graduating in 2017. And I just did a quick model for a 10-year term, a 25-year term, because those are the two most common repayment plans, the standard repayment plan and the 25-year extended repayment plan. And so I mapped out, just kind of like I did earlier, total interest. I did kind of a monthly payment per student. And then I did a total principal that would be remaining after 5 years. Because one of the things I think that's frustrating about student loans is, you pay on them for 5. If you put it on the 25-year term, after 5 years, like the example earlier, you've been paying and paying and paying, and it's like it doesn't budge, right? So just showing you the math why it's not moving. So I just wanted to show what would happen before, instead of saying cancel the $2 billion, like just write it off, say okay, all 12,000 students, you have zero debt, okay? That would cost $2 billion. If you were to just lower the interest rate, to 3%. I showed 3% as an example, or to 1.5%, which would allow, 1.5 is used a lot as kind of like a inflation rate, right? So it's allowing to have some type of amount of money to go to the lender, because the lender has costs, right? People don't pay their bills or just, handling the loans. There are costs, right? So when you look at the total interest paid, if everyone, had selected a 10-year term, our total interest paid in the 6% is about $677 million. That drops all the way down to $158 million if it's only 1.5% over 10 years. And then looking at it again, if you look at the 25-year term, you're at nearly $1.9 billion in interest. So you nearly double the principal on a 25-year term at 6%. But we can drop that all the way down to $407 million in total interest paid. And you can also look at the monthly payments. You can drop the monthly payments from $1,800 a month to $1,400 a month, which a lot of students might be able to afford, from a monthly payment perspective. And then on a 25-year term, it drops all the way down to $655 a month for the payments. But anyway, you can read the full paper if you have real interest, more of an interest in this. I'm happy to talk with you after class or whatever. We can talk in more detail. But I just wanted to show that, if rather than getting into the cancel debt, not cancel debt, and wherever your politics are, I think there's some other components that we're not thinking about, or other issues that we're not thinking about. Like if we were to cancel the $2 billion, one, that's expensive, right? So it'd be expensive to cancel the $2 billion. Whereas you could, over 10 years, basically drop the interest paid from 677 to 158. So you're basically taking revenue away from a business that would have made 677 million in revenue. They're only going to make 158 million in revenue. So we need to subsidize that business. So what I'm saying is, let's subsidize the interest. It would be much cheaper to subsidize the interest and allow the students to pay down the debt, themselves, but not pay so much to the lender. And the reason why I think that this is a good argument is that a lot of people agree that student loan interest is too high. Like that's something that's not, Republican or Democrat, whatever, like 90% of people are like, yeah, we need lower interest rates. But when you get into canceling debt, well, what happens, canceling debt, again, it's what if you had students who were paying their student debts off, like they were doing, they maybe they went to a cheaper school, they took out the minimum amount of loans just to get by, they made choices to spend less. And then we're saying that their debt gets canceled at the same level as someone else who, went to the most expensive school, took European trips, vacations every summer, putting it all on the gram or whatever. Like, they're living high and large. And so I think you would build up resentment between us, right? So why create all that resentment by forgiving some people's debts and then not really supporting those that have that have made other choices. I just think this is a way we can think about it. Maybe we can advocate for lower interest rates, something that might be a little bit more of a moderate, or more people might be able to agree with, rather than just full debt cancellation. So what are some other questions I kind of want to leave you with as you think about debt? Again, go back to answering the question for yourself. Is debt good or bad? How do you evaluate it? I'd argue it's neither. Debt's debt. And you just got to evaluate what are the things that are good about it, and what are the things that are bad about it, right? And then maybe you could go a little bit further. What are some debts better than other debts? And yeah, maybe that's the case. Again, I go back to saying, well, it's really math. They all have those components: principal, interest, and term. And we, roll with it like that. Some have tax implications, some have other incentives. So you got to just consider that and look at the fine print. And then asking yourself, what are the benefits of a longer term for your loan? And what are the benefits of a shorter term for your loan? Because a lot of times, especially with student loans, we went to the school we're going to, and, our cost of living is what it is. And we don't really make that much as a pharmacy technician or intern while we're in school, because we can't work that much. So it's like, you're going to take out the amount that you got to take out, whether it's $150,000, $200,000, that, and it's a big number, but that is what it is. But when you get to your 4th year and you're like, okay, now it's time, we're graduating and going to take a job and start paying this down, you're going to have the decision, shorter term, longer term. You need to ask yourself, what are the benefits of each? What can you afford? What is it that you want to do? What are your goals? And that's how you can sort of evaluate that. Because I get asked a lot, Dr. Mattingly, should I pay my student debts off faster? Should I let them go longer and invest in other things? I'm just going to ask you, in your opinion, what are the benefits of each? Okay. So that's pretty much all we've got. If you got further questions, feel free to shoot me an email. This might be a good topic to chat online and kind of get some other engagement from some non-class folks too. You might get some other pharmacists that might chime in. So maybe it'd be fun to comment in YouTube in the comments below, and also on Twitter. So happy to do that as well if you'll want to engage a broader audience and into this discussion.